Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm speaking with Airlie's Emma Fisher. Emma is the Deputy Head of Australian Equities and she's going to be talking to us about the risks and opportunities she's currently seeing in the Aussie market. Emma, it's great to see you.
Thank you so much for having me.
Emma, you wrote a fantastic article for Rampart talking about the bizarro world that was investing in 2025. The headline along the lines of, it felt like beyond the laws of reality. So what do you make of 2026 so far? We've already had a lot of interesting events in a short space of time this year. And then how should investors respond when the markets are rewarding behaviour that seems irrational?
Yeah, I guess like most fund managers, I thought I was going to have a nice quiet break over January, but that hasn't been the case. I guess what I meant when I was talking about investing beyond the laws of reality over the last year has been a lot of the factors that we look at and look for in companies over a long period of time that have been associated with good outperformance. And these are normally quality factors. So things like low levels of gearing, high return on equity, issuing a low level of shares, and making good profits. Those four factors have all flipped in the last 6 months. And in fact, businesses with low ROEs have outperformed those with high ROEs. Businesses with high levels of debt have outperformed those with low levels of debt. One of the worst strategies of all time, actually, in the ASX has been to just buy loss-making companies each year. I think a portfolio of loss-making companies over the last 25 years has compounded at something like negative 20% per annum. But every now and then, that bucket of loss-making companies has these enormous rallies. And you saw one in 2021, when interest rates fell through the floor, loss-making companies went bananas, and that unwound pretty quickly, and it was pretty ugly. And similarly, in the last 6 months, again, you've seen that loss-making portion of the market rally something like 40% in the last 6 months. So I guess those factors are a little bit of a head scratcher. It's not what you see over the long term, so I wouldn't expect, any sort of sustainability to that kind of junk-driven part of the market. If you look at the last 12 months, the top performing business on the ASX 200 was DroneShield. And not to pick on that stock, but I suppose maybe it's indicative of the market that we're in. At Airlie, we have a quality screen, sort of like a quantitative screen for the market, and it has a bunch of green flags and a bunch of red flag indicators. And DroneShield trips up quite a lot of red flags for us. You've got governance issues, insider selling, it's a loss-making business. I think that kind of typifies the sort of market that we're in. And now tipping into 2026, we've seen, this precious metals rally that's been quite extraordinary. And equally, I guess, in terms of what's not working at the moment, what many are calling the SaaSica. So software as a service stocks, tech stocks have been absolutely smoked as the market grapples with what AI means for their business. Are these business models going to be disrupted in the way that they disrupted their previous competitors? So, that's sort of the dynamics of the market at the moment and what investors, I suppose, are grappling with. In terms of how do investors maintain their cool and maintain rationality in the face of all this irrationality? I mean, you just got to ground yourself in the fundamentals. Equities as an asset class has been the best performing asset class over any time frame. The very long arc of history. It's outperformed gold. It's outperformed property. It's outperformed bonds. And the reason for that is that businesses retain a portion of their earnings and they reinvest it. And so you can access this power of compounding over a very long period of time when you're investing in equities. But in order to do that, I guess, first of all, these businesses have to make a return. And that's why we avoid loss-making businesses in our portfolio. And secondly, those returns have to be sustainable. And that really is where all of the art and the science of investing lies. It's all well and good to, identify with 100% perfect hindsight which companies make good returns, but all of the alpha and all of the future performance comes from correctly identifying those that are likely to continue to make good returns. And equally avoiding those where returns will, normalize. Competition theory basically says that most businesses are going to, if you're making an excess return, you're going to get competition and it's going to bid your return back to a normal level. So you really want to avoid that, being caught in those businesses that are at that phase of their life cycle. So yeah, just grounding yourself in fundamentals and using what's worked over a very long period of time as a way to kind of cut through the noise of the FOMO that you might get if you're trying to chase what's working now.
Emma, I just want to explore that a little bit more because we live in a relative world and everyone wants performance. I guess I ask this question for the investor sitting at home again that is, looking at the same market that you are and going, geez, I'm really missing out, or, I need to jump on these things that are moving. So just from your perspective, how challenging do you find it as a professional?
Yeah, I mean, it's very challenging. I guess what you're really talking about here is cycles. I have enormous respect for what the market is telling you. And I think the large weight of money is often correct. And it's often correct at identifying the winners and the losers from various sort of, long-term structural developments. But equally, it can certainly go too far in either direction. And I think that's often where your hunting ground for new ideas is, where it might have gone too far in one direction from a negative perspective. And equally, I think one of the most powerful things you can have as an investor is a general sense or a general feel for where you are in the cycle. But the FOMO is enormous, right? Like, and I feel it too. Like, one way I try to ground myself is, take contemporaneous notes, right? Like, I'll give you an example of this. IGO, we own IGO in the fund. So it owns a quarter of Greenbushes, which is, a freak hard rock asset, very low cost, incredible grade, really, really large, long mine life. So an incredible asset. But lithium was, went from the most loved to the most hated sector over a 2-year period. And, it's hard to, it's easy to forget right now in January with the share price at above $9 that, not even, I think 7 or 8 months ago, it had a 3 handle. I think it even one point, it very briefly had a 2 handle. So because it's really fresh in my mind, I remember exactly how I felt as an IGO shareholder at the bottom. And I actually took notes about how I felt at the bottom. And I felt like an idiot. I never wanted to see that ticker again. You go to meetings and you're just hoping that no one asks you about that stock. You start to construct scenarios about why prices will never rise again. I'll tell you where my mind was going at the time. It was thinking, oh, well, China don't care if they don't make money downstream in lithium, if they're going to make money at the battery level. The world is awash with supply. So even if prices recover, it's going to be short and sharp and it'll be squashed with a wave of supply. So it could be any sector. When you're at the bottom of a cycle, your mind will start to construct, and the market, more importantly, will start to construct a narrative around why prices will never rise again. And so you pay attention to that feeling, and that's usually a pretty good signal. Like, you're never going to pick the bottom, but that's a pretty good signal that there's been a lot of capitulation in the share price, and potentially that's pricing in far too bearish outcomes. Because if you feel that way as a professional investor with access to management, with every tool under the sun at your fingertips, everyone's probably feeling that way. All shareholders would be feeling that way. And equally, I'll pick something live to the wire, I suppose, that, we don't know is a top, but certainly is showing signs of, again, I'm not going to be able to pick the top, but what signs do we have that we're closer to a top than a bottom would be the gold sector, where, again, these contemporaneous notes, how I'm feeling, I feel like an idiot for not owning any. I am tripping, our office is in Martin Place, so I'm physically tripping over every day a big line of people lining up to buy bullion at ABC Bullion. We've got an intern in our team who he's in uni, and he was telling me that all his friends that used to invest in crypto coins are now all trading junior gold miners. So again, like, these are all, anytime you open up Twitter or Substack or Reddit or whatever your, financial social media of choice is, it's the entire discussion is precious metals, silver and gold. So to me, these are the signs that I wouldn't call it a top necessarily. And again, that plays into the gold dynamic. It's really hard to prove, because it's just an idea, right? Like, in a sense, its upside is uncapped, which is why you start to create this narrative. Just like at the bottom, you create a narrative that things will never get better. When you're towards the top, you start to create a narrative why it's different this time. These aren't cyclicals, it's structural. Central banks are buying. We're never going to get on top of our fiscal deficits. I can't, create a credible counter argument to those points. Those are all credible points. But just pull up the gold price chart. Just pull it up for the last 40 years. Like, you are buying here, and you are buying, if you're buying Aussie listed gold miners, you're buying a leveraged price on here, a leveraged play on being there. So it might work, but to me, it's now in the realms of pure speculation. My ability to apply my own investing principles, the returns that business generates, it will be able to generate through a cycle, I find it difficult right now when applying those conservative assumptions to make the valuations for any of these businesses stack up. Meanwhile, you just really want to allocate capital away from the herd, not necessarily always being contrarian, but looking for ideas where the balance of favor is the balance of probability is shifted favorably. To give you another example, I mentioned before this sort of SaaS route. We didn't own any tech stocks for a long time because, again, we felt that their valuations were pricing in incredible optimism for a very long period of time. And now that most of these businesses have halved in a short order, I think they're interesting again. So, we're really pouring over that sector. And to date, we've bought small positions in Xero, bought a small position in Life 360. And the work is ongoing, but ultimately, I guess we're taking the opposite side of that trade. I've seen many times in my career. I'll give you an example, like when Amazon was entering Australia, you couldn't give JB Hi-Fi away. It was clear that this was going to be a loser, and Amazon was going to absolutely wipe the floor with them. And meanwhile, the stock's probably up 5 or 6x since the entry point of Amazon. So, GLP-1s and ResMed would be another example where the market shoots first and then, gets way over its skis from a valuation perspective, and suddenly it's baking in too much pessimism forever. And if a company can keep grinding out really solid earnings results, then the business eventually re-rates.
Emma, there was so much in that answer. One thing I just wanted to touch on, I was literally walking through Martin Place earlier today, and I've been seeing the ABC bullion lines on social media like everyone else. I reckon it was the longest today that I've ever seen it. And of course, gold was hitting fresh highs overnight. And then the other point, IGO, that's been in my portfolio for some time. And just the way you were explaining those emotions that you went through, as a holder of that for a while, I know exactly what you're talking about. I totally agree with the way that you laid that out. But we digress. I wanted to bring it back to a note that you hit a couple of times last year was about management teams destroying value, and this idea that you have of, first they should be doing no harm. So I just wanted to ask, from an investment perspective, what are the biggest warning signs that you've seen that a management team is about to do itself a mischief?
So, the really annoying thing is that often you don't get a warning sign. So if I give you a couple of recent examples. So, to their credit, James Hardie, obviously that's the one that springs to mind lately about value destruction through large scale M&A. To their credit, they were honest with investors that they were looking at doing M&A. I guess where there was a bit of a communication breakdown was the quantum. And clearly, the lens through which they were looking at value creation differed markedly from the lens that we wish that they had been applying. We had a meeting with the chairwoman a few weeks before they announced the deal, and we came away from that meeting, in our naivety, perhaps feeling as though anything that they bought, it was going to be quite incremental and sensible. So we were blindsided by that, despite the fact that we knew that they were looking at M&A. Aurora would be another one where, management were upfront about wanting to do M&A, and they always talk to the market about their ambitions being, in the North American market where they already were, and around bolt-on. So sort of incremental bolt-on M&A. And so again, we were okay with that because we thought they understood the North American market and that it wouldn't be large. And so we were totally blindsided when the deal that they did do was a very, very large bet the farm acquisition for a European glass manufacturer. So this is them stepping into a region that they had no prior experience. So, unfortunately, there actually are, I've learned now, there pretty much are no signs that management are going to do something dumb. I mean, the best thing that you can look at, I suppose, is management teams' track record of capital allocation. And if they have a sensible track record, perhaps that continues. Equally, I guess what I've developed over the years is sort of like a list of what I don't like to see when M&A is announced. The first one is a bet the farm acquisition, and I would define that as a situation where you're buying a business that's worth more than a third of your market cap. And I don't like bet the farm because if it goes wrong, you've really bet your whole business. So, you can destroy a lot of value that way. Equally, if they've debt funded a lot of it or they've geared up their balance sheet to do it, that's where you get a lot of risk. Another one would be where you're acquiring people businesses, where, the real asset in a business lies in the people and the relationships that they have. And I've just seen time and time again, you're writing these people huge checks, the escrow expires and they walk. Or worse, in the case of Reese, for example, in their US business, they go set up down the road and try to pinch all of your customers from you. So buying assets, real assets, where the value is in the asset rather than the value being in the people who can walk. I think that's important. And, entering new countries via M&A, very, very, very skeptical of that. We like international growth. Obviously, the upside for a company that can execute on international growth for an Aussie company is enormous, but you really want to look for situations where they can do it organically. One of the reasons we like Chemist Warehouse, for example, or Sigma, is the fact that they're having success overseas and they're doing it organically. I think they probably invested maybe like $5 million when they originally went into New Zealand, and just generated profits, generated revenue to fund the rest of the rollout. And this, I think they've been there for about 7 years, and as it stands today, they've got over 60 stores. They're probably doing close to $100 million of profit in that business with very little capital invested to begin with. So looking for those organic rollout opportunities, I think, gives you access to the upside of execution without the associated downside of having bet the farm to begin with in a market that you probably don't understand.
Emma, I'm going to tie a few threads here together, so just bear with me. Again, something that you wrote recently, looking at the mining space, I'm quoting you here: poor management plus windfall commodity prices are a recipe for the checkbook out at the top dynamic that has sadly been a feature of most commodity cycles. So I love that line. It's so true. So then I wanted to press you a little bit about Rio Tinto, which I think you've recently taken a position in, if I'm not mistaken. Rio Tinto, as you would well know, has a long history of purchasing assets at the wrong point in the cycle and paying the wrong price. I know it's a completely different management team, but just talk me through, what you're seeing there and, how you're willing to let that go and the past history go and focus on the opportunity that you see now.
Yeah, well, look, the first thing I'd say is I don't necessarily know that we will let the past history go. I mean,
Right.
our original thesis when we invested in Rio, and this was quite a recent investment for us, was that, we see the same dynamics around copper that everyone is falling over themselves to gain exposure to, in the sense that, you've got a lot of AI-driven demand, electrification-driven demand, and it takes a hell of a long time to get a copper asset up and running. So you've got this real restricted supply outlook. And we felt that the diversified miners, so BHP and Rio, were real laggards in this market where the pure play copper players were up, 60, 70, 80%. Even though BHP and Rio had a pretty good year, they were still, dramatically undervalued for the copper portion of their assets, very, very high quality copper assets. And we liked the incoming CEO, Simon Trott. We really liked the strategy that he outlined at the Capital Markets Day. I say that ironically because it does feel a little like a rug pull. Like, we're only talking about December, where he was telling investors, hey, we've got this great organic growth story. We've got all of this organic growth in our portfolio. We're going to simplify the business. We're going to pull out costs. We're going to do asset sales. And that was basically, manna from heaven for what we were looking for. And now, 6 weeks later, we're suddenly talking Rio Tinto. So it's difficult not knowing the facts, right? Like, we're still investors. We're going to assess it on its merits. It's difficult to sort of jump at shadows, particularly when, you are starting to see that long-term copper thesis play out in the copper price. You don't want to let go of a really good business with really high quality assets too early, because the press is saying that they're looking at a merger with Glencore. We'll know in a matter of weeks. I mean, one of the good things about UK takeover laws is that they have to, put up or shut up pretty quickly. So I don't want to speak ahead of the detail, because they may be able to pull something together that is actually value accretive for Rio shareholders. But suffice to say, we're skeptical.
Emma, we've covered a lot of ground. I just wanted to ask you for sectors. I know you maybe don't think about the market in terms of sectors, but where are you finding parts of the market that are attractive? And, you've talked about, sort of staying away from gold at the moment. What are some other areas where you'd probably stay away at this point in the cycle?
Yeah, it's a good question. In terms of what we're finding attractive, like, I actually can't remember a time in markets where we've had so many interesting ideas kind of come our way. And whether that's just quality businesses that we haven't owned for a number of years for valuation reasons suddenly get caught up in this, what I would call like a quality bear market, and these very, very sharp repricings. I think the classifieds look really interesting. I understand why, again, like, there's always a kernel of truth in what the market's doing, right? It's not as though this enormous weight of money, particularly in the US, is driven by total idiots. They're correctly identifying the fact that, the terminal value has likely changed for software as a service companies or businesses that are exposed to the impacts of AI. But equally that, they can compress that too fast, and that's where you find opportunities. And some, it's these sectors, what I find a really interesting dynamic, a signal for there potentially being some good buys in a sector, is when a sector sells off as a pack. I mean, it's different when you're talking about like a mining sector where, well, actually, even within a mining sector, when a commodity price falls out of favor, that's when you can buy the highest quality assets. So we talked about IGO before. Yeah, so there's certainly, a quality differential at the bottom of the cycle in mining businesses. But equally, there can be a disruption differential at a time where you've got this narrative that's saying any business that's a tech stock, any business in the ASX GICS IT sector, it should be cut in half. Its value should be cut in half as a result of the advancements that we're seeing in AI. So you just sort of apply reasoning, I suppose, to it. So, if I take the classifieds, for example, a business like REA, what's the impact of agentic AI? Do we enter a world where we're no longer interfacing with a website? I can see how the market might, very quickly shoot that stock as a result of that. But then when you kind of apply the next layer of thinking, to me, it sort of seems as though AI would be trying to solve a problem that doesn't exist, in the sense that when you go to sell your house, it's not as though you're wasting hours searching and that you could get some big efficiency dividend by just asking ChatGPT to send you, 5 listings that meet a certain criteria. You're not selling your house often enough for that to be a big pain point. When you are selling your house, it's your most expensive asset. So it's sort of the opposite, actually. You want to see every single listing under the sun. You want to canvas all your optionality. When you're buying and when you're selling. So I don't know how that use case is going to be disrupted by a more convenient offer, which is often what these, agentic AI is effectively offering. Similarly, so one that we've added to the portfolio recently is Xero. And Xero sort of straddles two things that we've talked about. It straddles the, transformative M&A that the investors haven't liked. And when I go through that list of things, they didn't bet the farm. It was like 10% of the market cap, maybe 15% of the market cap. They didn't debt, the balance sheets virtually net cash. So while we didn't like it either, and I think that they probably did overpay for that asset, the share price has dropped by $10 billion. Melio was a $4 billion acquisition. So the market's wiped off like 2.5 Melios. And I think that's what your opportunity is. So it's got that dynamic playing out, everyone hating that deal. And also the fact that, Intuit in the US, for example, is selling off because everyone's worried that it's disrupted by AI. And again, you look at that and you think, well, let's talk about ANZ, where I think the bulk of the value, I'm not so sure about the US for Xero, but I think the bulk of the value in the ANZ and the UK businesses, they've got nearly 3 million subscribers in Australia and New Zealand. And, these are small businesses. So first of all, they're not going to be vibe coding their own, accounting app. Most of the time, these are, it's cash in hand, it's hand to mouth, it's such a grudge, not even a grudge purchase, but like it's such a grudge task for you. It's got nothing to do with your day-to-day business. So I think it'd be, pretty unlikely to me that you would all, see this widespread adoption of, less secure, less safe, AI native options. And also, when you consider the cost of this, it's not a huge cost. So you're paying on average $45 a month for Xero. So, even if these things were free, it's going to take up a lot of your time as a small business owner to learn a new way of doing things. And it's not going to save you that much money. So, and, 3 million people have to come to the same conclusion at once. So it's not like a enterprise SaaS business where you could lose some really big chunky contracts. So, that again, that's one where I'd look at it and say it's probably at, it's not that it's non-disruptable. It's probably there's a few reasons why I think it's at the lower end of the disruptability sort of spectrum. And now from a valuation perspective, the balance of favor is tipped favorably. So those are some businesses that I think are interesting. But it's been more broad than that. ResMed just keeps churning out fantastic results, growing earnings, double digit, and the share price, I was going to say going to nowhere, but it's down actually. You know, earnings are up nearly 20% this year and the share price is down 10%. So that would be another one that I think, is a fantastic business, no debt, very high returning. News Corp. So we don't own REA, we own News Corp, which owns 62% of REA. So a lot of its value is driven by what you might think about REA. So maybe you could look at it as, a lower risk way to play an undervalued REA, because obviously the other 35 to 40 odd % of the business is, Dow Jones would drive the majority of the stub value there. And I think that's a very high quality business. Wall Street Journal, again, in an AI world, those sources of truth, probably the value of those go up, that verifiability. So yeah, those are some examples of businesses that we like. I think the other part of your question was, what sectors am I avoiding? I mean, the other one is like, I still think, banks, the earnings have, if you add up all big four banks from 2023 till 2025, so the last 2 years, earnings for the sector have fallen 4%, and the share prices of that pack is up 50% over the 2 years. So to me, that's just not squaring. So that would be another sector that I think I would avoid. I just think it's, overvalued for the growth that they're delivering, which is precisely none. I mean, the other thing there is like Macquarie's eating their lunch. I've said it for a while now and I've been wrong for so long, but, it's starting to be right, I suppose, within the CBA share price, but the market has rotated into the cheaper banks and out of CBA. And I think the next leg, if I was a betting person, would be out of the cheaper banks. Macquarie has come from nothing to now at 6.5% of market share in mortgages. They have this sort of unassailable advantage of being, the cleanest tech stack. So they don't have all these spaghetti systems and all these inefficiencies that they have to, cover with their interest margin. In fact, they have the opposite. They're starting to get operational efficiencies now. So their costs are going down at a time where all the major banks' costs are going up. And so they're just going to keep reinvesting that in price and winning a lot of share that way. And they've really just, eviscerated any surplus profits that you had in Australian mortgages.
Perfect timing, Emma. I was checking my phone earlier and there was a Bloomberg headline that said BHP has now officially overtaken CBA in terms of market cap. So the rotation is real. It's happening in real time as we're having this conversation. I'm conscious of your time, Emma, so I did want to ask you one last question, and it just reverts back to that article that you wrote about the laws of reality. You had a great finish talking about, the things that investors are likely to see or would want to see to show that markets are becoming more grounded again. What are some other signs that you're looking for, just to, sort of show to the world that we're back to normal, if you will?
Share prices tend, over the long arc of history, share prices tend to follow earnings. And the reason for that is earnings are a pretty good gauge of what underlying returns are doing in a business. So that, returning to fundamentals mattering, returning to earnings, driving share prices rather than necessarily narratives. I mean, I called out ResMed as an example, but if you added together, I know this because, painfully over the last year, we own all three of these companies, but News Corp, ResMed, Aristocrat, three companies that are delivering double-digit earnings growth and paying out dividends, and yet their share prices have gone backwards this year because of this enormous D-rate. Whereas if you look over at the banks, for example, they're not delivering earnings growth, but their share prices have rallied because of this enormous re-rate. So I think, taking the other side to that bet, I'd much rather allocate capital to businesses that are growing double digit and have no debt versus highly geared assets that aren't growing at all and are trading at PE multiples that are sort of at all-time highs. So yeah, I'm talking my own book there, but that's certainly how I would define rationality in investing. And it's worked for a long time, I suppose. So I'm not ready to throw all my fundamentals out just because they haven't worked over the last 6 months.
Well, for everyone playing at home, hopefully we do turn to that sense of rationality sooner rather than later. Because I think, again, people are running around chasing a market, and it's usually when people are doing those sorts of things that they end up losing a lot of money. So hopefully that is not the case. But Emma Fisher, thank you so much for having a chat. Very much appreciate it. Thank you for sharing your insights with Livewire.
Thank you so much for having me.
If you enjoyed that interview, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.